that they've launched. But talking about launches, let's talk about something more traditional. It's hotels. Chalet Hotels actually has announced the launch of its new hotel, the Westin Hyderabad High-Tech City. It's a 168-room property, the second in Hyderabad itself, and it's about 168 properties, which takes their total portfolio to a little over 2,800 keys. Sanjay Sethi, who's the managing director and CEO at the company, now joins in. Before we talk about the numbers, it's commendable that this 168 key property will be managed entirely by women. So that's big ups from here at CNBC-TV18. We do the Future Female Forward series as well. But now let's talk about the numbers. 168 property, 168 room. What do you think the occupancy and the average revenue per room will be here?
Good afternoon. It's a pleasure being here, and we're really excited about this launch of this hotel, which is run by a full women team. And it was a dream that we had about a year and a half back. We've been able to execute it. Really excited about that. On the numbers itself, while I may not be able to give you forward-looking numbers, I can share with you that we've done a contract with a single entity with the hotel sold out for the next 3 years. So we are looking at a full sold out status with guaranteed income as a minimum guarantee, which will then have income over and above that for the next 3 years. So it's a great situation. Let me talk you through why we did this and why we think this will work brilliantly. Number one, there's a win-win situation between the client and us. They get the rooms that they need in Hyderabad in a single hotel. From our perspective, we get guaranteed income over the next 3 years' time. So there's no ramp-up phase. There's no period of building up occupancies. We start with 100% occupancy on day one. The rates have been designed such that they build up over the 3 years to exciting numbers, which I may not be able to share at this point of time. But what additionally it does for us is it de-risks our existing hotel of 427 rooms from losing any business to this one. So this hotel has built its own client base. It does not affect the existing 427 rooms, which will continue to grow at its natural growth pace. And we, in a business which is cyclical, we've been able to lock in the revenues with annual growths at very healthy rates for the next 3 years.
Okay. Mr. Sethi, I just wanted to understand this entire structure of revenues. So how much, I know you can't give any kind of numbers, but if you can give an indication in terms of what we can expect, what would it be probably as a percentage of your total sales in FY23? And are you expecting more such deals going into FY24? Is this a model that you would probably look to adopt more simply because of the kind of certainty that you have when it comes to revenue?
Sure. So look, I'll address the second part of the question first. I don't think so many such deals are available. It is a very unique deal. It's a one-off deal. If we get more opportunities, we'll be happy to do that. Are they going to be around? I'm not so sure about that. Coming to the first part of the question, from a numbers perspective, look, it's a 168-room hotel. So from a percentage basis, it is roughly around maybe 5-6% of the hotel portfolio, and will deliver that and maybe more of the total revenue for the portfolio. So it works well. It sits in extremely well for us.
Okay.
And you must highlight it over here before we move on to the next one. I think one of the big ticket items for us is there's going to be a low-cost operation for us because there'll be no sales and marketing team or revenue management team. There'll be no sales and marketing cost attached to it. It's a one-time cost. So our margins in this are expected to be better anyway because it's clustered with the existing. Now they improve significantly more.
Okay, so since your P&L is improving, your margins will improve further. Let's talk about the balance sheet as well, because that seems to be a bit of a concern, right, Mr. Sethi? I mean, over the last 4-5 years, your debt has gone up. You used to have a debt of around 1,800-1,900 crores, and now you're sitting at 2,500 crores. Is there more pressure on the balance sheet that one can expect, perhaps as you're going through a phase of, expansion, etc.? And what is the plan with reduction of debt? How much can you reduce it by over the next 1 year?
So all our debt is going towards growth capex, right? And none of it is really going towards burning cash in terms of the operation side of the business. On the operating side, actually, we are generating enough cash to cover almost about 90% of the capex that we spent in the last year. So I think it's a very healthy scenario. We are peaking out as far as the debt is concerned this financial year, and then it starts coming down, given the pipeline that we have and the fact that the large part of the pipeline actually gets operationalized this year. We of course have 2 large hotels and 1 office block which will continue for another 2-3 years, but they'll be self-funded internally. So our debt will actually come down from next year onwards and be back to the numbers that we had earlier in the next couple of years. Having said that, we are a growth-oriented company. If there are opportunities, we'd like to continue to grow, and we'd like to use the best form of currency that we have available for growth.
Right. Just doing some back-of-the-envelope calculations, the average revenue per room in that area should be around 7,500 rupees?
Yes, that's right.
And you're anticipating around 75% occupancy there, something that you've done over the last 4 quarters. Is that possible?
So that hotel will have 100% occupancy with the RevPAR of the numbers that you quoted.
All right. So that would mean room revenue of close to 45 crores per year, and you add some F&B, other events, banquet revenue, that would be around 76, 77 odd crore rupees. You will get the 77 crore rupees, or will you get a percentage of that? Just wanted to understand.
No, so our model, we get all of it, right? The brand actually operates and gets only a management fee, which is...
And how much do you pay the brand?
So typically, I'm not going to give you I won't give you details of the numbers of the contract that we have here, but a management fee contract works on top line percentage of about 2% and GOP percentage, that's gross operating percentage, of around the 7% mark. So therefore, the brand ends up getting about 5% of the top line on the blend of this. But the P&L balance sheet is all ours, right? So all of it flows through to us, including the employees on our rolls. And that's very important to understand, because every time we open a hotel, the contribution to EBITDA is very significant, as against asset-light businesses, which end up earning a very small percentage of the revenue and thereby EBITDA of the hotel.
Okay, all right, Mr. Sethi, we're going to leave it on that note. We've run out of time, but would have definitely wanted to know your thoughts about this summer season and the occupancies that you're probably seeing at this point in time, but we'll leave it for another time. Thanks very much for joining in and speaking with us. So that's Chalet Hotels. The stock is up around 1% They are confident about their new model in terms of the new hotel that they've opened in Hyderabad. But remember that debt continues to be a concern for the company. We'll take a short break, but we'll put the focus on IT stocks. They are under pressure. We have more on that with Rima. Stay tuned.